Hello everyone, welcome to the Capital Intelligence channel. Today, we've got a comprehensive explainer designed specifically for those of you who are truly serious about finance and investing. We're going to cut right through the noise, separate the actual data-driven market realities from all that retail hype you see online, and present the most essential information in the financial world right now. If you're looking for high-value insights on the structural shifts happening literally right beneath the surface of the market, well, you are definitely in the right place. Okay, let's dive into this. To get you the most essential information efficiently, our analysis today is broken down into 5 clear pillars: facts over market feelings, assessing the AI bubble, the complex ETF dilemma, zero DTE options and volatility, and finally, a fixed income reset. Section 1, facts over market feelings. In a market environment defined by rapid headline shifts, it's increasingly vital to ground our decisions in institutional data. So the crucial point is that while skepticism persists and bubble fears absolutely dominate the news cycle right now, the underlying fundamentals of the market are telling a very specific story. As Northern Trust points out, the final arbiter is the scoreboard in sport, the price in markets. Strong corporate cash flows, solid profit growth, and really resilient corporate balance sheets are actually providing a structural foundation supporting this ongoing market rally. And that's true even in the face of these elevated valuations. The facts right now are pointing to real corporate strength, not just empty sentiment. Section 2, assessing the AI bubble. This brings us to a massive systemic risk weighing on everyone's mind: tech sector concentration. Are we in an extreme bubble, a new golden era of innovation, or maybe a mix of both? To really understand the scale of this, we need to look at market weight. Right now, the Magnificent Seven, Apple, Microsoft, Nvidia, Amazon, Alphabet, Meta, and Tesla, they account for over 30% of the US stock market's total value. Just pause and think about that for a second. 30%. 30 years ago, the top companies spanned 5 entirely different industries, everything from industrials to consumer staples. Today, that top-heavy concentration is completely dominated by a single theme: technology and AI infrastructure. And this brilliantly illustrates the macro impact of all that concentration. A recent study by Yale University and the Cowles Foundation tracked the NASDAQ index over the last decade and a half. Just look at that sustained, significant rise starting right around 2020. It's wild, right? By applying some advanced bubble detection methodologies, researchers have tracked what they call mildly explosive tendencies across the broader market. And yeah, as you'd probably guess, it's largely driven by the rapid, almost wildfire-like adoption of AI technologies. But, when we drill down to individual stocks, the math gets even more fascinating. Check out the explosive divergence in the Nvidia to NASDAQ ratio. Researchers use this thing called the mildly explosive root, or MER model. Basically, it's a way to mathematically separate normal market growth from true speculative divergence. What the math actually reveals here is that Nvidia's price action hasn't just grown alongside the market. No way. It has mathematically outpaced broader market fundamentals entirely. It essentially entered this phase of explosive divergence, which perfectly highlights how individual stock momentum can completely detach from standard valuation metrics during periods of intense technological exuberance. So how do serious investors actually navigate this? Well, insights from T. Rowe Price suggest that while AI is absolutely a cross-sector growth engine, relying purely on passive indexes right now, that drastically increases your single stock concentration risk. As AI adoption inevitably spreads out into healthcare, financials, industrials, the performance gap or dispersion between the winners and losers in those sectors is really going to widen. This means active sector ETFs are becoming absolutely crucial tools. They help you fine-tune that mega-cap exposure, letting you target specific AI-driven opportunities without over-leveraging yourself on just a handful of tech giants. Section 3, the complex ETF dilemma. That search for targeted exposure leads us directly into this dilemma. We're currently witnessing an absolute explosion of alternative and complex ETF products. Let's de-jargon one of the most popular new vehicles right now, the derivative income ETF. Basically, these are funds that use option strategies to generate income, and they're sometimes offering massive double-digit yields. They've surged in popularity lately, with literally hundreds launching recently. But the promises and perils here are significant, especially when these strategies are tied to a single, highly volatile stock rather than a broad index. You really have to know the mechanics of what you're buying. Now, what's really interesting about this slide is the stark contrast in risk. Look at the YieldMax Nvidia single stock ETF. It boasts an eye-popping yield of nearly 46% and massive one-year performance, but it comes with extreme volatility, sitting all the way up at 28%. Now compare that to a diversified premium income fund like JP Morgan's, which offers a much more stable 8.5% yield with only 7.6% volatility.
Basically, you're getting paid for taking on the options volatility premium of a single stock, but man, you've got to be prepared for a much bumpier ride. Another heavily utilized tool we're seeing in this complex space is the buffered ETF. These are explicitly designed for risk management. Think of it like a trade-off. They cap your upside potential, meaning you won't capture the absolute peak of a bull market rally, but in exchange, they give you a predefined limit on your downside risk. For investors trying to mathematically balance their desire for yield against the fear of a sudden market correction, these instruments offer a pretty clever compromise.
Section 4. Zero DTE options and volatility. Beyond ETFs, we also have to understand the underlying mechanics moving the market on a daily basis. That brings us to the hidden driver of modern market volatility, zero DTE, or 0 days to expiry options. These are contracts that literally expire on the exact same day they're traded. Historically, income-focused investors used longer-dated covered calls. They'd hold positions over weeks, maybe months. But in a market where financial headlines can reshape entire sectors in hours, those traditional slow-moving models are really showing their age. Zero DTs are rapidly replacing them because they actually allow institutions and traders to recalibrate their exposure every single day. The result of this is a massive shift toward what we call adaptive income. In today's rapid-fire market, zero DTE strategies treat daily volatility as a feature rather than a bug. Instead of holding a single short call position through multiple economic reports and just hoping for the best, these strategies allow for real-time risk mitigation. You assess the market in the morning, deploy your strategy, and by the closing bell, the risk is completely cleared. It's a completely new paradigm for generating income. Let's move to and see how this builds into Section 5, a fixed income reset. With equity markets so heavily concentrated and derivative strategies driving daily volatility, serious investors are looking for stability. And right now, we're seeing massive structural opportunities in the fixed income market. According to recent outlooks from BlackRock, the 2026 fixed income landscape is defined by diverging global rate paths. This isn't a one-size-fits-all bond market anymore. Europe has experienced a major yield reset, offering higher real yields and significantly stronger credit fundamentals. At the same time, emerging market debt is rebounding, thanks to much healthier balance sheets and moderating inflation globally. Basically, what this means is that global fixed income is now offering incredibly compelling sources of actual yield and some much-needed portfolio diversification away from U.S. tech stocks. Ultimately, this explainer comes down to recognizing the vital difference between current volatility and long-term resilience. Chasing speculative individual stock bubbles, no matter how incredible the underlying technology is, just introduces fragility into your wealth. The alternative to that fragility is adapting to the current environment by structuring properly diversified, risk-managed portfolios. In practice, this means using active ETFs to manage that heavy concentration and leveraging global fixed income to provide a really reliable structural foundation. I want to leave you with this provocative thought to consider for your own strategy. How are you balancing the undeniable golden era of AI innovation against the strict mathematical realities of extreme market concentration? Because honestly, it is the defining financial question of our time. Thank you to all the serious investors who joined me today for this deep dive. Make sure to stay tuned to Capital Intelligence for more data-driven clarity. See you next time.